Hello, everyone, and welcome back to another edition of our monthly webinars. I'm lucky to be joined here today by my partner, Jeff Degner. We have a very exciting topic here today for you, something that a lot of the clients of ours deal with, and that is the topic of choosing a lump sum versus an annuity, or otherwise known as pension. So Jeff and I created a little slideshow here. We're going to try and keep this very brief and very informative and collaborative between the two of us. And hopefully you get a lot of value out of it. And Jeff, if you have anything to add, let's jump right in.
Yeah, perfect. So here we have Ausperity's legal team getting paid for their disclosures and getting into the introduction. We're gonna talk about pension plan types and factors to consider. Of course, Shane mentioned the lump sum payment, and we'll focus on some case studies. When it comes to choosing the lump sum, or the lump sum relative to the annuity, interest rates play a big role, and we'll talk a lot about that. Pension plan selection types, factors to consider, pros and cons of each, of course, and investment considerations. All of this will fold into a discussion with your financial advisor, likely us in most cases. But how does this decision weigh? And there's a lot of considerations from a financial planning perspective.
Great. Yeah. Thanks, Jeff. Yeah, and again, just as a brief introduction, I think that was kind of a great overview of some of the things that we're going to be discussing today. But first and foremost, again, this is a very big decision, right? So when you retire, you're going to have decisions to make about your pension or your lump sum. The lump sum is a lot of times an easy one because it's just one selection, whereas with the pension, as Jeff discussed, there's going to be different types that you can choose from, whether it's single life annuity, joint with 50% joint with rights of survivorship, 75%. All of those are going to be important decisions, and you're going to want to try and weigh the right one. So, again, that's one of the things that we're going to go over here today. Pros and cons to both options. A lot of times there's never a wrong choice, right? Both of them are going to be good options. You worked for a long time, and your hard work produced this for you. So, we're going to do our best to provide you with the guidance and the modeling to show what we think is best for you. But this is a personal choice. So in this presentation, we're going to discuss the factors you should consider when making the decisions. And then, as Jeff mentioned, interest rates, because that is obviously very top of mind for individuals right now. And it's certainly something you see a whole lot of on CNBC. That plays a major factor in the pension and the lump sum. So Jeff, why don't you kind of take us into the next slide where we talk about, some of those factors for the pension calculation.
Yeah. Perfect. Thank you. And again, as Shane referenced, all companies or whether it's corporate or government, there's a number of factors that can be company specific or pension plan specific. We're going to focus in on a few factors that are more common across the broad range. But service time or pensionable service, as it's sometimes considered. There's situations where an individual can leave a company and, maybe they come back to that company within a, 12-month period or under 12 months. They can be considered as, continued service rather than having there be a break in service and restarting that clock. Salary history, or average final pay, as it's sometimes called. This can be different based on company rules. Some situations that I've seen would be they take an average or an annual average of your 3 highest consecutive years, but within the last 10 years. And that's important to know, because what if you spend 30 years with a company and then in your final 10 years you start working part-time and at a reduced pay? That can have a major impact on your pension. Age at retirement. And you'll see I also reference age at benefit commencement. So retirement age is not an automatic indicator that you're taking your pension shortly thereafter. Your retirement age could be 50 years old and you leave and you go work for another employer. Well, there might be penalties or a reduction in your pension to initiate it at age 50. In addition, you might still have earned income. So you don't want to tap that well per se. And by waiting to a later date or deferring the pension until a later date, maybe age 60 or 62, that age 60 or 62 would be the benefit commencement date. So it's important to understand, the difference between the two. And also, in some cases, if you retire, the benefit commencement date or the earliest benefit commencement date would be the first of the month following retirement. Other factors may include, is there a cost of living adjustment? This is not very relevant within, corporate America, but can be for military or government employees. Payout choices, which Shane referenced earlier. You've got the lump sum, which is, a large chunk of money, or the monthly annuity. And an annuity is just what it sounds like. It's a monthly payment for the remainder of your life. But if you're married, there are options that you can choose that protect your spouse should you pass away early. And they're called survivor options. And you can choose anywhere from, in some cases, 25% and 25% increments all the way up to 100%. The monthly payout would be reduced for protecting not just you during your lifetime, but also your spouse. Some other options include term certain, which means that you'll receive the full payout for your life and as long as you're alive. But if you choose maybe a 10 or let's say 10-year term certain, then you'll receive that monthly annuity for your life while you're alive. But if you pass away in year 5, then a beneficiary or your spouse will continue to receive that for another 5 years. But after 10 years, there is no survivor benefit. Are you married? Again, this is an important consideration because the annuity tends to be more relevant with married couples, and lump sum is I don't want to say a no-brainer for somebody who isn't married, but are you married is a huge consideration. Adjustments for early commencement, what that would refer to is, are you being reduced or is there a reduction factor if you do take the pension prior to a certain age? Sometimes, or in most cases, it's kind of like Social Security, where every year you wait, you get a little bit of an increase. And there's an age at which they would consider you to receive 100% of your pension. Sometimes that's 60, sometimes it's 62, sometimes it's 65. Social Security offset. What that refers to is a reduction if you were to take the pension prior to age 62. We'll talk a little bit about that, but that's can be a little bit of a complex situation. Just know that it exists, and it's something to consider. Really, it's relevant with situations that involve taking the monthly annuity. And one of the most important factors is current interest rates and the effects that the interest rates can have on the lump sum. In every case, whether or not you are even offered a lump sum option with your pension, what the lump sum represents is what sum of money is needed to generate this same monthly payout. So whether interest rates are high or low, your monthly annuity is going to grow based on the factors we just discussed. Your service time, your average final pay, age at retirement, and so on and so forth. Interest rates are not going to change that monthly annuity. But when interest rates are low, you need a lot more money to promise that same monthly payout versus, in the environment that we're seeing today. And that's why it's relevant, and that's why we're discussing this here today. Shane, why don't you talk a little bit about lump sum payments?
Yeah, that's great, Jeff. And, again, well said all around. And one thing that I would just add is, as he mentioned, This is not a one size fits all for either the pension or lump sum. And most importantly, every company is different. Some companies will offer both a pension and a lump sum. Some companies will only offer a pension. Some companies offer a lump sum and a pension, where you can get part of each. So it's totally going to be different depending upon your company. When you go to retire from a company, they will have kind of a dedicated retirement officer that helps you and gives you paperwork with those choices on it. A lot of times we find that's the best time for us to receive referrals or engage with new clients, is when individuals are going through things like that and they really have no experience. Another thing I would add is that especially here with the lump sum payment, a lot of clients who we have it at Merck, for instance, they may retire or separate from the company at say age 47 or 48 or age 50. And they are entitled to a pension or a lump sum. However, Merck and a lot of different companies, as Jeff alluded to, you're not even eligible to take that lump sum until you're age 55. So there's a lot of factors to consider when it comes to this, and every company is different. When it comes to the lump sum payment, I would say that I think in my experience here, majority of clients tend to lean towards the lump sum payment. And the reason there is because it gives you the most flexibility. The lump sum is just a one-time payment that you receive in full when you retire. I'd say the number one question that I get when it comes to the lump sum and receiving this large amount of money is this all taxable to me when I retire? The answer is no. It can be if you wanted it to. I'm not sure why you would, right? But the answer is no. This is not a taxable event if you don't elect it to be. What typically happens, right, with most lump sums is that money is eligible to roll over into an IRA. So for clients that are with us or even newer clients, a lot of times they have existing IRAs that money can roll over directly into. Depending upon your company, once you fill out the pension election form, that typically takes a month or 2 months for whoever to process and then get over to you. But as I mentioned, this option gives you the most flexibility with your money. You can use the money however you see fit. 9 times out of 10, we're going to invest it, spend it, save it for later. And this is most important. It's, the hopefulness that you can pass that wealth on to the next generation. The lump sum is the most control you can have over that money that you receive. You choose how to invest it, or working with us and somebody like us, you kind of in tandem can really try to invest it and what's best for you, and try to grow that money over time simultaneously while taking withdrawals, right? And with those withdrawals, you're trying to maintain your current lifestyle. Right. And nobody wants to retire and then have to decrease their expenses. So a lot of times with the lump sum, you will roll that over into an IRA and then start taking monthly withdrawals, much like a pension, except it's not guaranteed. You need to invest this money responsibly and have it grow along with taking withdrawals moving forward. A lot of times clients don't need to take withdrawals immediately. Say, for instance, if somebody retires from the company at 55, right? For instance, Merck & Company. And then all of a sudden they decide to go get another job for 5 years. Right? They, take that lump sum, they roll it into their IRA, they work for the next 5 years, they don't touch it. Hopefully that money grows, right? If you can get a 7% rate of return on your money over 10 years, that money will double, right? So if you don't have to touch the money in your IRA for 10 years, that $1 million hopefully becomes $2 million, right? You're growing legacy wealth, or you're growing your bucket that you can then utilize to withdraw in retirement. Again, this is a good option if you're comfortable managing your own money, right? Or have great financial advisors, a little shameless plug there. And you're confident that you will make, wise investments decisions moving forward. The disadvantages of lump sums is that you are exposed to market risk. Now, I hope all clients know that over time, markets do go up, right? But, every couple of years, such as years like last year, you're going to have to deal with downturns, right? Both in, the stock market and the bond market. Last year was the worst year of investing since 2008. It can be difficult, right? But, if history repeats itself, which it tends to do, right? Hopefully that money that you take will grow over time. If the stock market declines after you retire, you could end up with less money than you received. Again, perfect example. Individual who retired in 2021 took their $1 million lump sum, invested it last year. right? And essentially that money may have gone down, 10%, right? Now, that's not permanent, right? But if you're taking withdrawals and your money goes down 10%, it's harder to make up that gap. Whereas with the monthly annuity, as Jeff will talk about, you're getting that guaranteed income every single month. Again, this is all planning, right? So Jeff and I, Rory, all of us are able to model this out for you, whether or not you take the lump sum versus the pension. But the most important thing to know about the lump sum is we do need to model whether or not that withdrawal rate will match up with the amount coming in from the lump sum, right? To make sure that that money can be extrapolated over 30, 40 years and, essentially last you for the rest of your life. So again, a couple of factors to consider with the lump sum. I would say, most clients tend to lean this way, but it's not a one size fits all. So, that's the lump sum. Jeff, why don't you tell us, here we're going to go into a few case studies here just really quickly. Again, high level, but Jeff, why don't you give us kind of a good example of the pension annuity and somebody that might take that?
Perfect. Thank you. And we're jumping back and forth between the annuity and lump sum just to, hit home some points. I mean, this will talk a little bit more specifically about some of the things I had mentioned earlier. In this example, let's assume Pat retires at the age of 60 with a basic pension benefit, and basic pension benefit refers to, the maximum amount that they would withdraw, little to no survivor benefit. However, Pat in this case is married, and Pat's spouse is also age 60. And this kind of shows you the impact that the different survivor benefit options have on that monthly amount. So you're going to take a reduction because what an annuity is it's insurance, and you're insuring not just these payments over your lifetime, but another's lifetime. In addition, in most cases with two individuals exactly the same age, the male in this case has a shorter life expectancy. So life expectancy plays a role here, which is why the annuity would increase if you defer it or do not commence the benefit to a later date, because these payments would be made over a shorter life expectancy versus retiring at age 50 and beginning the pension at age 50. There's a longer lifetime, to make these payments for. But in this case, again, you see a small reduction. Let's say that the spouse were 5 years younger than Pat retiring. In that case, you would see a much greater impact in taking the joint annuity, 100% survivor, or even the 20-year certain. So again, to explain further, 20-year certain means that you and or a spouse or beneficiary will receive those funds for a 20-year period. But it could be longer than 20 years as long as you're alive. But after year 20, should the annuitant pass away, the benefits or the payment would cease at that point in time. I think Shane is going to talk a little bit about a case study involving the lump sum. Shane?
Yep. Thanks, Jeff. And yeah, just in regards to, another example, right? Jeff and I think could go on and on about different instances with clients and clients' families and their situations, but these are two easy examples that both of us put together. In my example, I'm referring to a husband and wife, or a husband and husband, wife and spouse. Essentially, we're looking at a family, very common, two 401ks, both $500,000, so totaling $1 million. They've both been working for 30 years, so they've got full Social Security benefits for both of them at age 67. Client A is retiring at 65 and has the option to choose either the lump sum or the pension. Client says to us, hey, what should I choose, right? I've heard the pension is great because it's guaranteed income for the rest of my life. What is this lump sum option? Well, what we're first and foremost going to do, and in Jeff's example as well, is we're going to get the big picture, right? All of our clients that are listening to this know that we have already most likely, unless they're a new client, built a financial plan for them and been updating it throughout their tenure here at Ausperity. So again, we're going to collect all the information and we're going to do some modeling. In this instance, this client spends roughly $5,000 a month. Let's say they don't have a mortgage. They know they're going to receive $3,000 a month each in Social Security. Their goals, right, kind of in order, are to continue their normal lifestyle throughout the retirement. They don't want to have to decrease their spending, right? And then number two is to leave legacy wealth to their children. Options are as follows. Number one, they can take a lump sum for $1 million, or just, disclaimer, I threw these numbers out there. They can take a pension, single or 50% survivor for $3,000 a month, right? In our opinion, right, and most likely what the model will show without showing the cash flow here, it's going to be better to take the lump sum over the pension due to two factors, right? Number one is that the clients only need to live off of $5,000 a month. That's what they've expressed. That's what they're used to spending. They don't see themselves increasing their spending dramatically in retirement. Well, if the clients are receiving $3,000 a month from Social Security, let's just say it's just involving one client here, even if it's involving both, right? If it's $3,000 that they're receiving from their Social Security and they're only spending $5,000, that means that they only need an additional $2,000 a month from their investments to meet their normal lifestyle. So with $1 million portfolio, that means that we would only have to generate 2.5% in interest and dividends off of their $1 million, right, for the year to kind of supplement their monthly spending to get them to that $5,000, right? So what that means, right, in reference point, right, money markets right now are paying almost 5%, paying a little over 5%, right? So what that means is that to us, right, it is better for them to take the lump sum because we think that not guaranteed, but confidently we can generate that 2.5%, right? That will generate to them each month that will allow that $1 million to continue growing throughout their retirement. Now, to mention extra $1 million, right, that they can roll the lump sum in there, right? So now $2 million that can grow throughout retirement. Not to mention 2.5%, right, off of the $2 million is going to be double what they were receiving off one. So the interest and dividends that they're receiving off of their current investments and their invested portfolio is going to be able to supplement their Social Security to make sure that they don't have to worry about their monthly spending. So if they take the $3,000 pension, right, although it's not a bad option, right, this means that that client will be receiving an extra $1,000 to $3,000 a month in extra taxable income that they simply do not need, right? That means that that's driving them up into a higher tax bracket, right? And they don't need the income. And what happens is, and Jeff and I have seen this in the past, either with referred clients, is now they're receiving income that they simply do not need. And what do, Jeff? They give that money to us. We put it in a brokerage account. That money grows. And then if they need money, they're paying capital gains. So they're paying taxes on income that they don't need, right? And now, right, if they want to use that money, they have to pay more taxes to the government in the form of capital gains. So again, that situation is perfect example of why somebody would take the lump sum over the annuity, right? Number one, because they don't need the additional income. They don't want to pay more taxes. But number two, you now have $2 million that is sitting there and growing, right? You're not even touching it. You're living off of the interest and dividends, right? So that $2 million is going to sit and grow for the rest of your life. $2 million growing over 30 years. If legacy wealth is important to you and leaving money to the 3 kids in this example or grandkids or whatever it might be, right? You are a prime candidate to take the lump sum. So yeah, I think that's kind of a really cookie cutter situation, but a lot of times that is what we see. So, having a conversation and doing that modeling with Jeff, Rory, or myself is really going to be beneficial when it comes to weighing those options. And realistically, just as a last thought, we can model out both you taking the lump sum and the monthly annuity. So you can see the real time, right, what it looks like projected over the next 30 years in our capital. So, secondly here, just as we kind of transition into the interest rate side of things, I mean, Jeff, why don't you go into interest rates a little bit as, I think that this is going to be very timely for clients given where, the huge move in interest rates have made in the last year and how they're greatly affecting their lump sums.
Yeah, absolutely. And I mean, to Shane's point, this is kind of why it's kind of hitting home. I mean, we've been working through clients, working with clients through this, pretty regularly over the past couple of years, and anybody that's within, let's say, within like 2-3 years of retirement should have a good understanding of how to run a pension estimate from within their company, whether it's something that they run or they run, have somebody from the pension administrator run and send back. Because in some cases, the tools available are they can tell a lot, and you even in some cases have the ability to, I guess, run and understand the sensitivity that the lump sum has to interest rates. So you can tweak the interest rate, 0.5% or 1%, just to see how that impacts the lump sum. People will say, interest rates went up and my lump sum dropped by whatever. I mean, again, it's all relative. The lump sum is the sum of money needed to generate the same monthly payout. But that is even the case, with annuities that are structured within the open marketplace. So I've worked with clients to say, okay, we'll look at that lump sum, but if the annuity is the right decision or the right route, let's try to look for an option that better suits your goals and long-term needs and protects your wealth for the long haul. But back into interest rates, they play a huge role. And Shane even mentioned right now, cash or money markets are yielding 5%. When we were looking at this, when interest rates were next to nothing, when you compare the annuity to the lump sum, and let's say you take that $1 million lump sum versus that monthly annuity, if that lump sum were to generate like a 3.5% rate of return, it would last you, and in that scenario, you were to take the same amount of money out. So 3.5% on the lump sum, and you're withdrawing, and paying yourself or creating your own annuity from that lump sum, it would last you over your life expectancy. In today's world, we need a little bit greater of a return, and that's because interest rates are higher. But the I'd say the attractiveness of the lump sum has dropped a little bit, so it's more of a consideration. And I think what's more important is, how does your pension plan use interest rates in affecting the lump sum? And I'll give you a specific example. Some companies will take an average of the entire 12 months, and that will be their interest rate factor. They'll use a combination of short term, intermediate term, and long term. And so it's a blended rate, but looking at what rates had done over the past 12 months, meaning, this year we've seen higher interest rates than we saw last year. Last year we saw higher interest rates than the year prior. So when we came from 2022 into 23, that transition in years, we saw a lot of pension lump sums drop in value. It's very likely that we will see the same going into 24. So if your pension plan does look at, the past 12 months, now some pension plans have like a quarterly reset where they'll look at, the interest rates over the past quarter, and next quarter you'll have an understanding, and you'll have a little bit of foresight into what sort of next quarter's interest rate is going to do to your lump sum. So I guess just digging into how the interest rates affect your lump sum specifically or affect your pension specifically are paramount. And all pension plans have a document that basically has all the rules and information that we would need to help you better understand or plan accordingly. And it's called a summary plan description. So every pension plan has a summary plan description, every 401k, every long-term incentive comp plan. So the summary plan description for your company's pension is something we can use to assess how interest rates factor into the calculation. But yeah, as interest rates drop, more money is needed to generate the same monthly payment, which means the lump sum will increase. But I don't think we're seeing interest rates dropping anytime soon. Higher interest rates mean lower lump sum. This snapshot, I mean, it's something I remember early on in the industry, and it refers to, the effects that interest rates have on bonds. And really, I've discussed this with clients. I mean, if you have $1 million 401k and $1 million lump sum pension, well, that $1 million lump sum pension, what it is, it's a bond. It's a giant bond. So right out of the chute, if your 401k is 50% stock, 50% bond, you're actually, your collective allocation is 25% stock, 75% bond.
Great point, Jeff.
Yeah. I mean,
I don't think most clients realize that, right? It's when their lump sum is there, your allocation is not what it seems because of that cash/bond position.
I mean, whether you take it as a lump sum, and at that point it stops becoming a bond, and then you can choose how to reallocate those funds. But up until that point, that is a bond. And then, in the instance where you take the annuity, it continues to be a bond, a fixed income spigot that's turned on and never turned off. And what it will do is create less of a draw upon your other assets. Your other assets would be used as a supplement. Shane, why don't you talk a little bit about this this visual?
Yeah, we discussed this kind of here in prior slides, but as Jeff mentioned, it's these things are all about interest rates, and more importantly, the lump sum is all about interest rates. 2 years ago, and clients have even seen this, right? Clients are knowledgeable to it, right? 2 years ago, your lump sum before COVID was probably the highest it's ever been in 30 years, right? Whereas now, right, it's not as favorable because the Fed has raised interest rates the most in 40 years. We now have 10-year treasuries, hitting, their all-time, high since, November of 2007. So, interest rates play a big factor, right? And they were, very favorable for a long time, but now we're in this transition period. And that's why we thought that this, webinar would be really beneficial for clients. So obviously, it's a very important decision, but also it's one that shouldn't be taken lightly, especially given where in the transition that interest rates have made here in the last year and a half. So again, this is just a good visual of what a 1% rise, what a 2% rise, what a 1% drop can do to the value of, your lump sum. And as Jeff alluded to, that lump sum is going to be directly tied to the monthly annuity, right? And what it, would be for you to receive that amount of money over your lifetime. So again, just a good visual here, just to kind of illustrate all the things that Jeff and I have spoken to here over the course of the presentation so far.
Yeah, and after this discussion, I mean, we're going to be posting this video to our YouTube channel. But if anybody ever needs a copy and wants to look at this more closely, we'd welcome you to reach out.
Yep.
And I know some of you are going to sit there and say, well, Jeff sounds like he's very pro annuity and Shane's pro lump sum. I mean, when we carved this up, it was, Shane he was talking about the lump sum, I'm talking about the annuity. We're really kind of playing devil's advocate here. And Shane mentioned something earlier. It's not a one size fits all. It's something that we need to look at how this plays a role in all the other moving pieces
Absolutely.
of your life and your financial plan. Yeah. And
same thing we say to every client, right? Everybody's different. Everybody has their own specific, financial plan tailored towards them. And, the reason why we build these is for situations like these that sometimes come about abruptly, right? Is we can model this in a matter of, a day, right? In terms of whether you should take the lump sum versus the annuity. And a lot of times it's going to be tied to client specific situation and their family needs and their goals.
Yeah. And about at least once a year, we will host, a webinar, and it will be focused on, behavioral investing and what our emotional responses can cause us to do, and it causes us at times to think irrationally. So I just think that the concept, or one of the major benefits that people tend to hold their hat on, or talk themselves into this monthly annuity, is that it really helps them sleep at night. And if you're somebody that cannot take seeing you receive $1 million lump sum, you put it into an account and it drops 5%, and then you're pulling your hair out. If you cannot withstand that, I mean, because we very likely might go backwards before we go forwards, and unless we're using cash like products that have fixed rate of return. But what I would say first and foremost is that the company, the annuity that's structured from the company, has limitations. So I would recommend exploring, if you need this sort of peace of mind and comfort, I would definitely recommend exploring what type of annuity you could have structured by funding it yourself within the open marketplace, because you're removing the tie that you have with that company that you work for forever. With the monthly annuity, most annuities are, or most pensions are, insured by the PBGC. I mean, in most cases it's required. So if the company goes out of business, you're going to be made whole, but there could be a reduction in being made whole. You could be made whole 90 cents on the dollar. Same can be said for structuring an annuity on your own. You're at the whim of that insurance company being in business, but we're leveraging the open marketplace, but we're looking at very reputable companies, Jackson, Pacific Life, Lincoln, and we can look at options that provide wealth transfer even when you and your spouse are no longer here. So maintaining a cash value, protecting you and generating income in your lifetime. God forbid something happens to you, protecting your spouse and continuing that income. And then after your spouse passes away, hopefully maintaining some sort of value that transitions within your estate. And I think that is, something that really tends to drive people towards that lump sum, is having value that you can transition to heirs. So I think that's kind of, we hit a lot. We talked about a lot. I again, any questions, concerns, you know where to find us. But the decision to take a lump sum or pension annuity is a complex one, and I think we've said it several times. It's not a one size fits all. Considerations in taking the lump sum pension, you should make sure that you understand the risks involved, and I think more importantly, understand how your company goes about, calculating or adjusting the lump sum versus the annuity. Because in a lot of cases, we were in this environment where the lump sum was almost a no-brainer when interest rates were low, and then the pandemic hit and they went even lower. And, we saw lump sums jump by 20%. And yeah, they've come back down, but I'd say that the value, relatively speaking, is not like a no-brainer, take the annuity. It's just more of a consideration. And I'd say one of the more important things to consider is not the lump sum versus annuity, but what happens if rates continue to go up? And what if I plan to retire, January 1st, 2024, but by retiring a month, by retiring a month into the new year, my lump sum might drop another 20%. And I think that's something we really want to hit home is we've seen it. We've seen situations where by not acting within a certain period of time, it's caused, a shift in value.
Yeah, that's a great point, Jeff, because, again, I've spoken with clients about this in the past, and we actually had a number of clients from North Horizon retire almost abruptly, beginning of last year or in 2021, because interest rates are going up so much, right? And what happens with that is if interest rates are going up and you're pretty set on the lump sum, if your lump sum is going to drop $100,000 and you're making, 150 to 200 a year, you're working for half the price, and half the salary. So it's, Jeff, it's a great point. It's a very important consideration to look at interest rates, and determine its sensitivity to your lump sum. If interest rates are high, you want to take a look at, the annuity, right? And depending upon your family situation and your goals, or even if you're a high spender, right? Sometimes that, the annuity might make sense. But it's definitely important to understand the payout options, explore the open marketplace, and the lump sum can be used to purchase annuity outside of the company, as Jeff alluded to. A lot of times with insurance companies, right? Insurance companies are rated by Moody's and Fitch, and you can pick one with the highest rating, right? Or you might have a little more sense of security as opposed to, as Jeff said, bringing one with the company where if they get a lot of business, you got to look for the PBC, insurance makes you whole, right? So that's the question mark surrounding it, right? And again, all those things can be discussed. And then lastly here, before we wrap up, this is something that we put together that, I think Rory would be proud of. He loves the if then that. This is a perfect example of, okay, if this, then what, right? And it kind of walks you through kind of in, almost like a little bit of a maze here, right? And so, ask yourself these questions. And if these questions are yes or no, it kind of takes you to the next part. And, again, it gives you a really good kind of roadmap to, whether or not to take the pension of the lump sum. Not to say to go off this entirely, right? Definitely talk to Jeff or Rory or myself or your financial advisor, but I think it's a good visual and good something you can reflect back on, at least as a starting point. I thank you everybody for being on and listening in here, whether it's on the YouTube page or off of our website. Jeff, great mustache, and thank you for joining me here. This was great use of time and one of my favorite topics, and I think it's certainly one that clients come across a lot. So probably one of the biggest decisions they make in their lifetime. So I'm glad that we've got something that we can, put in the library here for clients to reference in the future as well.
Well put. Perfect. Thank you, everyone.
Thanks, everybody.
Yep. If you've heard, if you've worked with me in the past, you've probably heard me reference, but the confidence and trust you continue to place with us it's continually earned. So thank you. And, we welcome you to share this with anyone that you think might benefit.
Absolutely.
Thanks
again, everyone.
Thank you.
Bye.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.